Hey everyone, and welcome to this explainer. If you are anywhere near the high-stakes world of commodity procurement, you probably already know that right now the global nylon market, or the Polymer Bazaar as we often call it, is going through a massive structural split. Entering late August 2026, we are seeing this dramatic divergence between PA6 and PA66, and it's absolutely impacting bottom lines all across the globe. So let's dive into this right away and unpack exactly what's happening, why it's happening, and, most importantly, how you can adapt. Okay, let's take a quick look at our roadmap for today. We're going to cover the global nylon bazaar, then look at upstream feedstock pressures, explore regional market divergence, map out your market outlook and strategy, and finally wrap up with some really crucial Polymer Bazaar resources. All right, diving right into Section 1, the global nylon bazaar. Just staring at raw pricing data without a real narrative is honestly just noise, especially in markets that are this volatile. Right now, buying sentiment across the major trade corridors is moderately active, but it's incredibly selective. And that reveals a really clear structural split. On one hand, PA6 is showing a distinct firm to upward bias. It's just being aggressively pushed higher by raw material inflation. But then, on the other side of the coin, PA66 is seeing this localized stability. End users are essentially putting a ceiling on prices right now through highly cautious, need-based procurement. So overall spot price movements are just kind of stuck in these narrow corridors while everyone waits to see what happens upstream. Moving on to Section 2, upstream feedstock pressures. So if the structural divergence we just talked about is the effect, well, this value chain is the cause. It's a classic domino effect. Step 1 begins with firming benzene values at the very foundation of the chain. Naturally, that directly triggers Step 2, which is surging costs for caprolactam. That's your key precursor for PA6. And finally, Step 3 is the inevitable result of all of this, a global squeeze on producer margins. Producers are really feeling the heat from these baseline costs, and it's forcing them to fight to pass those costs downstream to the buyers. To really grasp the sheer scale of this pressure, try not to panic, but we are looking at a massive 51% surge. Down in North America, U.S. Gulf caprolactam shot up from 92 cents a pound in late February to $1.39 by mid-August. To put that into perspective, that translates to a massive increase of $1,036 per metric ton. When your raw material jumps by over $1,000, aggressive downstream price hikes aren't just likely at that point, they are basically a mathematical certainty. Now let's jump over to the Asian bazaars, where we can see this feedstock split clearly mapped out. Spot caprolactam for PA6 is assessed high at 13,070 RMB per metric ton. That's actually trading above the producer list price of 12,750 RMB. Meanwhile, adipic acid, which is your core input for PA66, is holding remarkably stable at 8,500 RMB. So the crucial takeaway here is how supply tightness in inputs like cyclohexane creates this really strict floor-level support for baseline costs across the key regional manufacturing hubs. It essentially keeps PA66 baseline production expensive, even if end-user demand is playing it safe. That brings us to Section 3, regional market divergence. Global commodities, right? They never react identically everywhere. Local supply chains, import arrivals, regional economic health, it means that what's true in Texas might be completely different from what's happening in Frankfurt. In North America, PA6 producers are aggressively hiking prices to preserve their margins. We're talking about BASF announcing an additional $220 per metric ton effective September 1st, and Advancix pushing a $265 hike. But look across the Atlantic. Europe contrasts sharply. Soft regional demand there, combined with an influx of competitive imports, actually pushed DDP Northwest Europe PA6 prices down by 104 euros per metric ton. It's a completely split reality based entirely on geography. Now, shifting over to China, the PA6 market is definitely firming up. Conventional bright PA6 chips have reached 12,850 RMB per metric ton. And this isn't just a feedstock story, it's operational too. We're seeing scheduled plant maintenance turnarounds, constrained spot availability, and incredibly low factory inventories. All of that is combining with those firm benzene prices to support higher quotes from producers. But again, keeping with our global theme, PA66 prices in China remain steady, simply because buyers are acting with high caution due to the high cost structures. Finally, let's check in on India, where the domestic trading clusters are acting in a very measured, range-bound manner. Down in Mumbai, nylon 6 is sitting between 217 and 219 rupees per kilo, with nylon 66 slightly higher at 330 to 332 rupees. Up in the Delhi regional bazaar, quotes are just slightly higher than that. This steady range reflects some very measured buying activity across India's crucial western and northern automotive and electrical molding clusters. They're buying exactly what they need, but absolutely refusing to panic. All right, section 4, market outlook and strategy. So you've got all this global data, but what does it actually mean for your bottom line on Monday morning? Well, according to Polymer Bazaar's latest analysis, the forecast for the global PA6 bazaar through September 2026 is definitively firm to upward. And this momentum is going to remain intact because spot availability is incredibly tight. Buyers are just starting their preseason inventory replenishment, and honestly, upstream costs are showing absolutely zero signs of a sudden collapse. But of course, as any good analyst knows, you always have to watch for the market correctors. There are three main factors that could moderate this upward momentum. First, if plant maintenance units return to operation faster than anticipated, injecting a sudden burst of supply into the market. Second, if we see unexpected weakening in feedstock values upstream. And third, if downstream converters simply hit a breaking point, aggressively resisting higher offers and flat out refusing to buy until prices drop. So here is your actual playbook. Step 1, do not delay your essential purchases. Hoping for an immediate market correction is a pretty dangerous game right now, given these massive feedstock pressures. Step 2, avoid speculative overstocking. Buying too much at these peak levels carries a lot of unnecessary financial risk. And Step 3, keep an absolute hawkeye on upstream benzene and caprolactam availability. Let that daily data dictate your volume decisions in the smart, phased buying approach. And finally, Section 5, Polymer Bazaar Resources. To actually execute a disciplined strategy like the one we just talked about, you really can't wait for a monthly newsletter. You need real-time intelligence. Polymer Bazaar has built an incredible ecosystem for exactly this. Their standout tool right now is an AI-powered WhatsApp chatbot. You can literally ask it a market question and get a data-backed reply in about 5 seconds. It's a game changer. To get the detailed reports that inform today's explainer, just text the word nylon to +91 93746 24365. And hey, if you found this breakdown valuable, be sure to like, share, and subscribe. So, to wrap things up, we've seen a massive 51% feedstock surge in North America, steady resistance over in Europe, and calculated caution across Asia. This structural divergence in the global nylon bazaar isn't just a theory. It is a daily reality that is testing the resilience of manufacturers worldwide right now. So I want to leave you with this critical question to take back and discuss with your team today. How are you adapting your specific supply chain to survive and capitalize on these raw material feedstock shocks? Strategize on that, and we will catch you in the next explainer.